Hey everyone, welcome into Market Takes on one of the best days of the year, one of the 8 best days of the year. It is Fed Day. We are breaking down the Federal Reserve's September meeting, talking about what they said, what they didn't say, talking about the statement. We got a summary of economic projections. Y'all down with S.E.P? You know me. Listen, we're going to be getting into all that right here on Market Takes. Of course, we're going to talk about the Fed statement and all of those things. We're going to break down the chairman's press conference. Let's get into what we're going to be talking about. We are going to be talking about, like I said, that statement, the biggest takeaways from Fed Chair Powell's press conference. Of course, we're going to be getting into the market reaction, showing you how stocks, bonds, currencies, and across the markets, how they responded to what we heard and what we saw from the Federal Reserve today. And we're going to be talking about how the Fed sees the economy based on what we got in this statement and the summary of economic projections, the dot plot, and all that good stuff. Because every so often, 4 times a year, the Fed gives us a little extra in its statement that really helps us break down and understand how they're looking at the future. So we'll talk about that. We'll talk about the current state of the Fed and what to watch next. So all of those things, we're going to go a little bit long here on Market Takes. So I hope you're strapped in and we are going to get into it right now. So first of all, let's talk about that Fed statement, right? What changed from July's meeting to this meeting in September? Not a whole lot. Actually, BMO rates analysts describing it as effectively unchanged. Rates are still at the highest in 22 years. And actually, let's throw up here on your screen a chart of where we are in terms of the Fed funds rate. So what you're looking at right there is how the Fed funds rate has moved going back to the year 2000. And as you see, like I said, we are at the highest rates right now that we've seen in 22 years. Rates were not changed at this meeting, but they were raised in July, so we are still sitting at that higher level. The big theme, the big takeaway from this meeting was higher for longer. And so there have been some expectations that we were going to get to these high levels we're at right now and then come right back down. In terms of what the Federal Reserve is predicting, in terms of what Fed Chair Jay Powell told us today, that's not going to be the case. At least that's not the case the Fed has priced in. And this chart here just illustrating how far we've come from when rates were very high in 2000, went back down, were low for a long time, and now they're higher, and the Fed predicts they're going to stay high for a while. In terms of the statement, really some pretty minimal things. The only differences were in the first graph of the report, changing job growth or economic activity had been expanding at a moderate pace, now a solid pace. Job gains have slowed instead of been robust in recent months. But then the Fed added, but remain strong. So job gains have slowed, but remain strong. Those were the only 2 real statements. Goldman Sachs describing it as the release was more hawkish than expected. We will get into all that. Most of that was in the dot plots. But in terms of the statement, in terms of what they said, the changes they made, pretty minimal, nothing big that jumped out at me, and certainly nothing big that jumped out at anybody because there were very few changes to the statement. Here's why those changes matter. And economists can argue about solid versus moderate, whatever. That seems like obviously all the changes that the Fed makes to its statement are intentional, but we will see just what those changes mean. I think we get a little bit more context from Fed Chair Jerome Powell at the press conference, but I think the Fed really acknowledging that the labor market is slowing down, putting that but remained strong in there, kind of knocks that a little bit, but really knowing that the labor market is strong. The Fed's saying, okay, things are slowing down. This labor market that had been very hot for a while is starting to cool down. Suggests they like what they're seeing from the job market with unemployment rising, job openings declining, getting closer to one another. Again, job openings have been very high, unemployment has been very low. Those are coming more into concert with one another. You still have about 1.5 or more than 1.5 job openings for every unemployed person here in the United States, but those numbers, again, getting back close to each other, that's what the Fed wants. And I think that was really the biggest takeaway you could take from the statement. Not a whole lot. And again, it was interesting that there was very little change in the statement, given that in July they raised rates and in September they did not raise rates. Usually there's a justification. They say, okay, here's why we raised rates in July. We saw this, 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 and this. And then when they don't raise rates, they say, okay, we didn't raise rates because of this, this, this. These statements were pretty much the same. I noted the same thing in July when they raised rates. There wasn't a big change from what rates had previously been in June when they chose not to raise rates. Now, let's talk about the dot plot. I want to put a chart up here on your screen so you can see just what the Federal Reserve is predicting and projecting for the next few years. Now, the first thing you'll notice is that in 2023, this is where the Fed expects rates to be at the end of the year. So right now, rates are between 5.25 and 5.5%. The Federal Reserve policymakers, 12 of them are expecting to raise rates one more time this year. 7 are predicting that rates will not rise. So where you see those 7 dots on the left side of your screen, that's Federal Reserve officials saying, we've done enough, we've raised policy enough, we don't need to raise interest rates anymore. And then there's 12 more folks in the committee who are saying, yes, we do. We need at least one more increase. There's only 2 more meetings left this year. There's one in November, one in December. And you've got more than half of the committee saying we need to raise rates again. Another interesting thing about the dot plot is what you're seeing in 2024. So by the end of next year, a smaller number of officials see rates being cut down. If you looked at this back in June, there were a number of Fed officials who expected rates to be below 4.5% by the end of next year, meaning that they would cut rates at least 3 times. You had a couple folks expecting even more than that. What you're seeing now on your screen there is expectations for only a couple more. There's only 2 officials who expect rates to be below that 4.5% mark. Everyone else expects that the Fed will cut 2 times or not cut rates at all from where they are. You've even got one official predicting that rates will actually increase by the end of next year. That is a very big difference from what we saw in July. And that really, I think, illustrates the change that we've seen in terms of expectations for the outlook. And that's what it's all about. Again, the big term or the big theme from this meeting here in September was higher for longer. Not necessarily we're going to raise rates a bunch, but rates are going to stay higher for longer. And that's what the Fed is trying to really beat home in terms of what they're saying through their guidance and what we got in this dot plot. That is a really big change. And economists have been talking about this for a while, that higher for longer. It doesn't really matter at this point because rates are above 5%. That's restrictive. That's slowing the economy down. It doesn't matter if they raise rates again one time, a couple times. What really matters is that they don't plan to cut them. And the market had been predicting the Fed was going to cut rates. The market has long been saying, hey, the Fed can't hold rates here for very long. They're going to have to cut. Well, we're seeing now the Fed saying, nope. Not only are we not going to cut, we are going to hold higher for longer. And that's what you're seeing there on the dot plot. And again, the market's still disagreeing with the Fed. If you look at Fed funds futures, the market still predicts that we're going to get at least 3 rate cuts before the end of the year next year. The Fed predicting 2 at most, and a lot of folks really predicting there's going to be 1, or in some folks even saying no rate cuts next year. So it'll be interesting to see how the market responds to that. Remember, when we got into the middle part of this year, that's when we really saw a lot of those expectations for Fed rate cuts. That was expected to happen this year. It has not happened, and it doesn't look like it's going to happen. And that's what caused a lot of the wobbling we saw in the stock market and a lot of the higher bond yields that we've seen over the last few months is the market getting used to and accepting that the Fed is not going to cut rates as they thought they would. So when you're seeing this big decline in tech stocks, when you're seeing bond yields rise to the highest in 16, 17 years, that has to do with these market expectations for rate cuts by the Federal Reserve really being wiped out and the market reassessing and saying, okay, the Fed's going to keep rates high. Fed coming in and saying today, we are going to keep rates high, and the market is going to have to react to that. And we are seeing some market reaction already. We're going to get to that in just a minute. Let's talk really quickly about the summary of economic projections. Now, the S.E.P is where the Fed says, okay, this is what we think the economy is going to look like over the next year or so. What was really fascinating was for the end of 2023, you've got the Fed raising its GDP forecast significantly. We can't gloss over this. The Fed raised its GDP forecast to 2.1%. So they think the U.S. economy is going to grow 2.1% this year for 2023. Now, here's why that's significant. In June, that's 3 months ago, the S.E.P said that they expected the U.S. economy to grow 1% in 2023. In March, there were expectations for 0.4% growth for the entire year. So the Fed has basically quintupled its rate expectations, more than quintupled actually, so more than 5x what they predicted as recently as March. That is a huge increase in terms of U.S. growth. And that means they're expecting not just a soft landing, but really for the U.S. to grow about trend, for this to be a solid growth year for the economy. And it's hard to square that with inflation coming down as much as they predict it'll be. They also lowered their inflation expectations for the rest of the year. That's a big deal. Lower the projections for unemployment, lower expected inflation level, and lowering their projections for core inflation, as in even when we kick out in food and gas prices and those energy prices, even when we kick that out, we think inflation is going to be lower than we initially projected only a few months ago. Basically, the Fed is predicting that not only will they get the soft landing, but they're also going to get U.S. economic growth coming in solidly, way higher than expected. So inflation is going to decline, unemployment is going to stay low, and we're going to get solid U.S. growth. Listen, that would be very bullish, very strong for the economy. It's not a recipe that you usually can put together. You need an expert chef to put together all those things: lower unemployment, lower inflation, and higher growth. The Fed is predicting a really nice cake, a really nice souffle, I might even say, and we'll see if they get it. Listen, let's talk about the press conference, because obviously there were a lot of questions about this summary of economic projections and the dot plot. Fed Chair Jerome Powell really putting those rose-colored glasses back on his face, saying, you know what? Things are looking good. Things are looking mighty fine when he talks about the data that we had seen. Now look, if you watch market takes, you know we've seen some potentially concerning data. We've seen inflation picking back up. We've seen retail sales picking back up and rising. That could be a bad sign again, because it pushes inflation higher. If folks are going out and just spending money buying things, they're just going to keep buying. Companies are going to keep raising those prices. People keep buying them. The prices keep going up. That pushes up inflation. We've seen gas prices, oil prices rise significantly. We're seeing the world Brent crude metric for oil rise up near $100 per barrel. So we're seeing all these signs that inflation is picking back up. But what Chair Powell said is, listen, the data we're seeing is looking good. The data we're seeing is looking positive. It's what we want to see from the economy. I think really the biggest takeaway from the press conference was Fed Chair Jerome Powell reads you a quote: "We have the ability to move carefully, and that's what we intend to do." The Fed is feeling pretty good right now. They're feeling like, okay, data is in the place that we want it. Fed Chair Jerome Powell didn't seem pressed. He didn't seem like he was anxious. He didn't seem like he had to make a move. He says, okay, things are looking all right. We're seeing what we want to see from the data. On the job side, on the inflation side, all these market metrics that we watch, things are looking the way we want them to look. I think that was the biggest takeaway from the presser, because unemployment has not risen significantly. Inflation has come down. It is giving the Fed the moment to kind of breathe, to sit back and say, okay, we don't have to move too fast. We don't have to take any decisive action now. We can chill. The other takeaway, I think, from this presser was Fed Chair Powell really acknowledging the differences and the differing opinions on the FOMC. You had 12 officials saying they expect one more rate hike this year, rates to go up, and then you had 7 saying they don't expect for rates to go back up. Market is not expecting for there to be another rate hike this year. So we'll see how we square that. You've got a lot of new folks on the Fed. We're going to talk about that in just a moment. But there was some acknowledgement by Fed Chair Powell today that, listen, we don't have a consensus. There's not an overpowering view that we need to raise rates or lower rates, that we've done enough or we need to do more. All of that is going to be decided, and it's going to depend on the data. And so the data is really going to move markets, especially if we get prints that are above expectations, especially on the inflation side. I think when you combine the press conference and the statement, the big picture was just the Fed feels comfortable with higher for longer, and that is going to move markets, I think, in the coming days. I think the biggest surprise about the press conference was really how Fed Chair Powell characterized the data, being so okay with inflation. CPI inflation was to 3.7%. That's moving away from the Fed's 2% target, and it was the second month in a row that inflation has risen overall. Fed being comfortable with jobs numbers coming in at 100,000 over the past few months. That just is enough to keep us in line for population growth. You need to add 100,000 jobs each month just to keep up with new people coming into, the population, people being born, people turning 16, 18, going out and getting those jobs. So Really, Powell, when he was pressed about some of these things, some of the weaker data, he kind of demurred a bit, said the Fed tends to look through volatility in those oil prices and things like that, really downplayed some of the bad readings or some of those numbers that suggest that inflation could be picking back up. So that was really interesting. Let's take a look right now and let's talk about what's going on in the markets, right? Because the markets reacted to this and we saw in a real way. Stocks did not like this very much, especially tech stocks. You see the NASDAQ here down about 1.5%. And if you see there, things really started moving right after the Fed's press conference right here at 2 o'clock. You see the statement comes out, stock prices go down, kind of recovered a little bit up to the statement. And then Fed Chair Powell started talking at that press conference. And after the press conference, things just went down, down, down. A lot of that had to do with what we saw in the bond market. Now, what we were seeing here with the 10-year yield, boom, you see it right there, right around 2 o'clock, you see a spike up. You see between when the statement came out and when the press conference started, okay, yields come back down and they pick back up. Bond prices fall as yields rise, and you see very clearly yields picking up. Where you saw the most pickup, though, was in these 2-year and 3-year yields, right? You see those big increases in the 2 and 3 year, and that's 7 basis points, 8 basis points. Those are most closely tied with expectations for Fed policy. So this is the market reacting and saying, we think either the Fed is going to raise rates again, or we think they're going to hold rates, because again, this is still not showing policy rates at where the Fed suggests they will be. Right now, the Fed rate is 5.25 to 5.5%. Well, the 2-year is at 5.17%, the 3-year 4.85%, as you see there on your screen. Markets saying, we think these rates could be higher and we're getting closer to the Fed policy rate. So when those yields go up, it makes things more expensive to borrow. It makes it harder to borrow money, to do things like take out a mortgage. And that affects everything. Look at currencies right now. You see the euro there. And again, you see that same thing, a big downturn right around 2 o'clock with that Fed meeting. You look at the US dollar index right here, basically the exact opposite. 2 o'clock, you see a big spike higher. Again, let's take a look at commodities. You see Brent crude right there, up around $93 a barrel, coming down. Usually when the dollar gets stronger and rises in value, you see oil prices go down. Crude oil, though, up over $90 a barrel. And this really, when we look at the markets, it's just illustrating what we're seeing in the reaction that markets are having to higher for longer, that being the big statement that we got from the Fed today. All right, so let's talk really quickly about what this price action tells us. It tells us that the markets are reacting. They are starting to believe the Fed. They have not believed the Fed for a long time. Really, I think as we've gone through 2023, markets have had to say, okay, maybe what the Fed said is real. Maybe they are going to hold rates higher. Maybe the economy can take it. For a long time, towards the end of 2022, early part of this year, markets were saying, no way, the Fed's going to have to cut rates. We're going to have a recession. Spending is going to slow down. Those job growth numbers are going to fall off a cliff, and the Fed's going to have to cut rates. That hasn't happened. And we are starting to see markets accept the reality that we're in right now, where rates are going to be higher. We will see markets still not saying they believe the Fed or they're buying what the Fed is selling in terms of rates being that much higher, but we saw very clearly in the markets expectations of higher rates for longer. That usually means a slower, more sluggish economy. It usually historically has meant recession. We'll see if that's the case going forward. In terms of how the Fed is looking at the economy, listen, Fed Chair Jerome Powell really ignored retail sales, that big pickup that we saw last month that was unexpected. He ignored GDP expectations that suggest in Q3, the third quarter, US GDP could rise by 5%. That would be huge. Didn't talk about that at all. So the Fed sounding very excited, very bullish on the economy, that we're not going to see too much growth. No worries about too much growth pushing inflation back up. We are seeing struggles from businesses in the Beige Book. No talk about that. He was asked specifically about that, kind of pushed it off to the side. I'm not really that worried. We're seeing delinquencies and defaults pick up. We saw the most August corporate defaults since 2009, according to the S&P, according to S&P Global. No talk about that. So the Fed's tone on business struggles, on inflation starting to pick back up again, on some of these growth numbers suggesting that, wow, this could really light another fire under the economy, pushed all that to the side, said job growth is coming down the way we want it. Labor markets are getting back in line with what we want. Said the data has been good over the past 3 months. That was certainly not what I expected, and I don't think what the markets expected, but I think the statement from the Fed, what we saw from the summary of economic projections and what we saw in the dot plot, a little more hawkish, leaning towards higher for longer. As I've said a number of times, the press conference really was, was cool hand Luke, Powell saying, listen, I ain't worried. I got to get that dirt off my shoulders. And that's what he did. Let's talk really quickly about the current state of the Fed, right? Who we're seeing making those decisions and who's casting votes, right? Because the Fed composition has changed quite a bit from what it was a year or two ago. We've got a number of new members on the FOMC, the folks who vote for Fed policy. Of the 12 members of the FOMC who vote on rate policy, 6 of them are new or newish, meaning they've only been around as long as President Biden has been in office. So that's, a little over 2 years, not even quite 3 years. 6 out of 12 folks, and one just joined. This was her first meeting. Adriana Kugler, economist, previously was a professor at Georgetown, just joined the Fed board at this meeting. But Michael Barr, new. Lisa Cook, new. Austin Goolsbee, Chicago Fed president, new. Philip Jefferson, new. Adriana Kugler, who we just talked about. Lori Logan, the Fed president of Dallas, new. So you've got 6 people who are on the board. You've also got someone like Christopher Waller, who's only been there for a few years, whose leanings and whose tendencies are not really known. Policy, how, when this data comes in, how the Fed's going to interpret it, we're not sure. And what we saw in the dot plot today was folks are not really aligned in terms of what they think. You've got a lot of folks in terms of the big question, are we going to raise rates again or not? There's uncertainty. There's 12 people who think yes, there's 7 people who think no. When we look forward to next year, you've got a lot of uncertainty. You've got a big change in terms of rates are going to be higher for longer, but are we going to cut rates? Well, we're not sure. And we don't know how a lot of these people think because their views have not been made clear. There's been an expectation that the Fed is going to be a lot more dovish, as in lean towards keeping rates low or reducing rates rather than keeping them high to bring down inflation. But we are in a high inflation environment right now, and we don't really know how a lot of these folks are going to react or what they're thinking or what their biases are. Usually there's a very clear set of who's a hawk, who's a dove, who wants to raise rates, who's going to be banging the table at those meetings for more rate hikes or more rate cuts. We really don't know that right now because the people on the Fed board are new. A lot of them aren't in the monetary policy circles where you'd hear them express their views, haven't been on the Fed previously, and so now that they're voters, we just really don't know what they're thinking or what they plan to do. So that's a big wild card for the market and something we're gonna have to be watching their speeches and really kind of listening in to see what they think before they make these meetings. I think going through the end of this year and into 2024, it'll be very interesting as we approach November, December, whether it looks like we're going to get a rate hike again and how the market responds to that. Because again, we have seen 2-year and 10-year yields rise to their highest levels since 2006 and 2007. We are in a very high yield environment right now. That generally is not good for stocks. It generally is not good for bonds, obviously, because when bond yields rise, those bond prices fall. So this could be an environment where you could be set for more losses going through the year if we don't get more good news. Be very interesting to see what happens in third quarter earnings and how stocks respond from here, because we obviously have seen some weakening so far this year. What do you want to watch out for next? Well, we get the PCE inflation report in just 9 days on September 29th. That is the Fed's favored gauge of inflation. As I said, we've seen CPI pick up recently. Over the past 2 months, it's moved higher. It was 3% in June, 3.2% in July, 3.7% in August. Does PCE follow that same kind of tone? And also on CPI, but we've also seen core CPI, as in when you kick out food and energy prices, well, it's come down consistently. That's housing and that's services, inflation, all those things, what your hospital's charging, what your lawyer's charging, things like that. Those numbers have come down. We'll see if those things continue. PCE is going to be very watched in 9 days. You're going to want to keep your eye on that. The next Atlanta Fed GDP Now release is coming on October 2nd, then October 5th. Again, Atlanta Fed's GDP Now is predicting 5% GDP growth in the third quarter. That would be a blowout quarter. It's been coming down, though, pretty precipitously. It was 6% just a couple weeks ago. Now it's 5%. We'll see. We'll want to look and see what that is on October 2nd and October 5th. And last but not least, the jobs report is out on October 6th. Listen, we will be breaking everything down on Monday here for you on Market Takes, so we'll be looking forward to all those things coming, but those are the big reports you want to watch out for next. Before we get out of here, Want to plug my new podcast, WSJ's Take on the Week. For more on what may move the markets, check it out. WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that may move markets, all so you can make smarter investing decisions. You can subscribe wherever you get your podcast. That's Spotify, Apple Podcasts, Stitcher. If you just want to go on WSJ.com, we got it there too. Check it out, WSJ's Take on the Week. I'll be talking to you there. That comes out every Sunday, 6 a.m. You can set your alarm to it. Hope you'll check me out there as well. Listen, that's going to do it for us here on Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. Thanks so much for joining us here on Market Takes, and we will see you when we do it again next time.